Okay, UK budget could have been worse. Let's talk about it from a private investor perspective. Basic rate capital gains tax on profits on selling shares to increase from 10 to 18% with the higher rate tax 20 to 24%. This is really not meant for building a shareholder democracy. Okay, now what does that mean? Well, it means it gives you an incentive to shield your shareholdings in ISAs and SIPs, not so much to try keeping it into a general investing account. Stockbrokers might take a bit of a hit on that, probably won't. Better for spread betting companies and CFDs. Sorry, not CFDs, spread betting companies. Okay, companies to pay national insurance at 15% was 13.8. Right, that's going to raise 25 billion in a year. That's massive. Okay, when you talk about inheritance tax loopholes and non-dom, it's peanuts. It's ideological with non-doms. All right. Uh, there's arguments to even say abolishing it is a bit stupid, but yeah, it's ideological. Or VAT on schools. It barely moves the needle. What moves the needle is national insurance on salaries. So that's employer national insurance. So that's bringing in a lot of money. That's effectively income tax on a proportion of the population, if you want to think of it like that. Companies. Well, companies, unless they're one-man bands or have very few employees or family companies, don't have a soul to be kicked or a body to be beaten. Therefore, let's go for them. In actual fact, it's quite clever. The reason it's clever is A, it raises a lot of money there. B, it's not corporation tax. It's actually national insurance. And actually, family companies won't be affected so much because presumably they'll have very few employees. Okay, so it really is putting a burden on the bigger companies. Now, that's not necessarily a bad thing because you might think, well, wait a minute, how will they cope? Well, let's say they sack some people in order to make the headroom to make the extra payments. Okay, that could be a negative outcome. What if they've got less profits as a result because their wage bill's gone up? Fine. Who suffers? The shareholders, the capitalists. You could argue ultimately the shareholders are pensioners who have shares in those companies. Well, only if they're big listed companies. So it's smart also because it puts the burden on the companies to break the bad news to employees that they're not going to get the pay rises they wanted and some of them are going to get sacked, or to shareholders to say profits have gone down because employment costs have gone up, rather than the chancellor saying it and raising income tax, which is what they used to do in the past. Okay, so is it a stealth tax? No, you're just getting the private sector to do the work for you, businesses in particular. Might be smart, might be really smart. Um, I'm attracted by that number. That's why. Main rate of corporation tax paid by the taxable price over 250 at 25%. Now, the problem with that is, and it's framed really cleverly. Okay, so credit to the chancellor on this one. It used to be 19%. The idea was the lower that is, the more you attract overseas investment companies to set up here, etc., etc., etc. Now, you can argue, well, no, we've got that stable now at 25%. You know what you're getting. A quarter of your money plus add 20% VAT. So that's an effective rate around 40-ish percent. Because let's say you're selling something for 120, well, 20% will go 20% of that, which isn't 20 by the way, 20% will go to the taxman. Then what's left, let's say it was all profit for argument's sake, it won't be. A quarter of it goes to the taxman as well. So you're roughly about 40% ends up going to the taxman. Uh, and you're his tax collector, not bad. But yeah, that's just saying we're going to keep it elevated on companies, which, it shouldn't surprise you. It's the Labour Party, it's not the Conservatives. Will that slow down investment? Of course it will. It's going to crowd out investment because if I had more money in my company would invest more. That it's not rocket science, is it? So obviously it's a crowding out, by the public sector by increasing taxation of the private sector investment. But that's not necessarily a problem if the public sector is going to do all the investing. Great. And making the economy grow. Essentially, a left of centre policy is we, the government, can do the investing better than the private sector can. Better meaning for a more just society. Right of centre is private sector can do the investing better than we in government can. Better meaning, well, for whatever the people want because they're the companies. So you can see pros and cons of both. Anyway, that's what people voted for. 1 in 5 of those eligible to vote voted for this. That's how democracy works. Inheritance tax threshold freeze extended by a further 2 years to 2030 with unspent pension pots also subject to tax. What that basically means is if you die and there's money left in your pension, i.e. you've not blown it and spent it in Vegas on your deathbed, then that will form part of your estate and subject to tax. Basically, if it moves, if it breathes, if it stops breathing, any of those things, tax it. So the income you've paid tax on and then put into your pension and saved, if you don't spend it, you're going to pay tax on it again, so that your children or whoever you're going to leave it to get less money. All for a just and fairer society. So might encourage spending, might encourage people to pull money out early from their pensions and start giving it to their kids or put it into some kind of trust for their children. None of those things would keep it out other than spending yourself. Trust wouldn't keep it out of your inheritance tax. Neither would gifting it, other than spending it. So maybe some people will think, well, bugger it. Why should I give 40% away? I'm just going to blow it. And the kids could go to hell, or grandkids or whatever. So that could be one way what might happen. Anyway, that's my take on the important bits of the budget if you're an investor, pensioner, that kind of person. Could have been worse. Could have capped lifetime allowance on pensions. Could have capped how much money can be withdrawn from a pension as people panic. Could have capped annual contributions into pensions. Will that come in future budgets? No, I don't think so. I think by changing the rules on how much money can be borrowed and doing this, I think that saves the bacon for pensioners. I'm surprised. I thought she would have gone harder onto pensioners on the basis that anybody with shares isn't a working person. If they're not a working person, they're fair game. I think by deciding to borrow more and having this move on NI, I mean, basically, the effective tax rate for many people is 50% because national insurance plus income tax. I mean, that has sort of, people think, well, national insurance isn't income tax. No, just call it income tax. It's a tax on income. Okay. That plus income tax, you're talking about 50%, let alone then when you buy something, you're paying 20% in VAT. So little wonder you're living hand to mouth. But then again, if the government's taking all your money, there'll come a time when you will necessarily, having spent a lifetime living hand to mouth, be relying upon it for benefits, which, well, they're taking all your money, they can pay you back later, since they're the better investor, they think. Shocking to think governments never set up sovereign wealth funds or bought stock in Amazon or Apple, since they're so good at investing and knowing what to do with money. Okay, that's me done.